Welcome once again to another episode of the Educated Homebuyer. This is a live edition. We answer your questions right here as we give you market updates and let you know everything that's going on in housing, real estate, economy, all that good stuff. And with me, once again, Mr. Josh Lewis. Josh, how are things in the mortgage business this week?
Well, I'm punch drunk, if that counts for anything. I had surgery last Friday, and I still feel like I'm woozy from the anesthesia. We'll go into some of the numbers, but market is not reacting exactly how we would have expected if you had just shown us this last 7 days worth of data and said, "What did the market do?" But yeah, you've probably all seen the headlines by now. Hopefully, you're not watching the Freddie Mac Primary Mortgage Market Survey, which will be 5 days late when it comes out tomorrow and not indicative of where rates are today. But the last headline I looked at here, rates at essentially a generational high here, 20, 25 years, something like that, without really any data to push us that direction, anything saying there's anything problematic.
Yeah, so last Thursday, we got CPI numbers, more or less came in line with expectations. On Wednesday last week, we talked in the show how core was likely to come in 0.1 better, and that's exactly what happened. So inflation was more or less exactly what we said last week, and the market reacted negatively. And then Friday, you had PPI, which came in a little bit hot. And then this week, yesterday, you had retail sales coming in higher or hotter than expectations. Today, building starts up a little bit. Builder sentiment, on the other hand, is down primarily due to rising mortgage rates. So a lot of confusion out there in data in how it's affecting everything. Today, we got the Fed minutes, and the Fed minutes were somewhat, I guess, in line again with expectations that the ceiling is more or less here for rates, at least for now, unless something shows inflation is out of control, at which point they'll adjust and maybe go a different direction. But either way, what we're going to do right now is we're going to dive into some charts as we do every week. We're going to look at inventory. We're going to look at what's happening in the overall housing market. And then we're going to talk about some other things that are going on with regards to, the mortgage business, foreclosures and LTVs and credit and all of these different components, what people are financing, just to give you an idea of the buyer out there in the market right now, because I think it's helpful to understand your competition in many ways. And this isn't indicative of every market, right? This is literally a very broad bird's eye view of everybody in the market. I mean, a couple weeks ago, I talked about a property I had in Lakewood, 26 offers on it. I actually did a video where I broke all those, not all the offers down, but what people were doing. It's probably going to come out next week. I wanted to put it out before, but we're waiting for it to close. But nevertheless, start putting your questions in now. If you're listening on the podcast, obviously you can't do that, right? And this is a couple of days old. But if you ever want to show up, we do this every Wednesday on, Jeb Smith YouTube channel, on the Educated Homebuyer podcast YouTube channel as well, 5 o'clock Pacific Standard Time. It's for an hour. So jump in, put your questions there. And we'd be happy to have you. So with that said, Josh, let's start rolling into some of the numbers here. So as we do every week, we're going to start with inventory. Inventory picked up about 5,000 homes this past week. I think it was like 4,700. We're going to look at the numbers here in just a minute, which is well below what we would like to see this time of year. Sitting at 484,599, puts Orange County inventory at 2,409, Huntington Beach at 202. Those numbers are up a little bit from last week, but really more or less flat for the most part. New listings, the reason, again, we're not seeing inventory picking up in a meaningful way is new listings. There's not new property coming to the market. Inventory is growing a little bit week over week because there's just less pending sales, right? So homes are sitting on the market a little bit longer. Therefore, they're calculated in each week's numbers. And therefore, you're seeing that grow, a little bit of seasonality playing into that. And likely, going to be slowing here over the next couple of weeks to months into the end of the year, unless you see rates go up considerably, which inventory may pick up a little bit. We'll see how that affects things, in a couple of weeks. So inventory, again, looking back to where we were a couple of years ago, 7-8 years ago, you can see this is kind of seasonal in the market, these ebbs and flows. And right now we're, well below where we were prior to the pandemic with regards to inventory and a more normal market. Anybody watching this, listening to this, if you want these charts, as I mentioned every week, there is a link in the description of the video, of the audio, where you can grab these charts and take a look at them. But weekly inventory change, we went from 487 to 492. So the chart I showed you a minute ago at 484 clearly is not correct. I must have put the wrong one in there. So it's sitting at 492, 140. Which again, it was the 5,000 increase or 4,700 increase. I just put the wrong chart in. Same week last year, we were sitting at 550 this time. So what, 58,000 or so homes less than last year, which was already a record low. Inventory bottom for 2022 last year was 240. Inventory peak was for this year is at 492, which is essentially where we sit now. Same week back in 2015, quote unquote, more normal market, we were at 1,203,000 homes on the market. Josh, pending home sales or median home list price. What am I talking about here? Homes listed, same price as last year, around 450. That's been more or less the same over the last 3 weeks. The median price of new listings coming to the market's at 399. What do we got here? Median price of homes in contract went up a little bit. Currently sitting at 485, which is more or less the highest price we've seen this year for homes that are currently under contract for the median price. New pending sales per week sitting at what, 68,000 this week, which is more or less the same pace as last summer, the same time. Total single family homes under contract right now, 417,877 single family homes in contract last year. This year, we're at 375,955. So that's why, right? Inventory is growing a little bit without new listings coming on the markets because you just got less homes going under contract. And Josh,
Jeb, with that number, if we assume a 30-day escrow, some are faster than that, some are a little longer. So multiply that by 12. I mean, you have seasonality, so it's not quite that easy. It's 4.5 million sales over the course of a year, and we're seeing the pace in the low fours. So it just kind of tells you more of the same. That general malaise and low momentum is there, not really moving a whole lot, but we've kind of put in the bottom and are just sitting here at that low level of annualized sales.
Yeah, and we'll talk about what could change the bottom, so to speak, here in a little bit once we get through some of these charts and start chatting. But percent of properties with recent price reductions, 34%, right? This is normal. Look at the years. I mean, the seasonality of previous years and how the number of properties with price reductions start to rise this time of year. So this isn't abnormal by any means. That's people that have had their homes on the market through the summer, which is typically the last good time of the year to get the most amount of money for your property. Generally speaking, people are now going, crap, my home's not selling. What do I have to do? Well, I have to reduce the price. Therefore, the number of those are going to go up unless people end up pulling them off the market. So Josh, foreclosures, as we talked last week, we showed a different chart, more or less sitting at all-time lows. But what do we have here?
Really, all I wanted to show, it's the same version of a chart that you've shown here, but showing that we are at all-time lows. And then now let's look there at why. Why is that? So the first one, negative equity rates and volumes there. So if you look, the blue, the amount in the blue there at the bottom is underwater mortgages, almost none, way under 1%. Limited equity mortgages, less than 10% equity is that gray at about 4%. So if you look at that historically, where we've been and where we were from 2000 to 2005 during that lead up, everyone has equity. So when we look at it, principal and interest payments on outstanding mortgages. So the average payment is the blue line, and this is a dual axis chart here. So we're looking over to the left, $1,400 is the average principal and interest payment for a homeowner right now. More importantly, the average payment as a percentage of median household income is 21%. So most people, as you well know, could make a $1,400 house payment plus taxes and insurance, and most people can afford to pay 20% of their household income. Housing for homeowners is very affordable. Unpaid principal balance and current interest rates on outstanding mortgages. So we now have seen this turn up. The green line, the average interest rate is up close to 4% thanks to the upturn over the last year. And the average principal balance is up at about $250,000. So look at that. The previous chart showed us really low payments. Why? Because the average loan amount is $250,000 at a 4% interest. Most people can afford that. So a lot of you are looking at this going, I don't understand. Well, you're probably in a high cost area. You're seeing the very high current interest rates and high home prices. So the numbers look very different for a potential buyer. This, Jeb, just kind of wanted to show you. This is the month over month. We went from all of this West Coast was red earlier in the year to all of it being green. So when we look at the year over year is still very moderate. There's just a lot of mixed signals. And what I will say with this, Jeb, this goes back to all real estate is local. You can't watch a show like this and have any idea of what's happening in your market. All of these markets are behaving differently. They're changing quickly month over month. You need to have an expert realtor on your side to help you analyze your local market. Someone that's looking at this data, knows this data, and knows it from multiple angles. Jeb, I don't know if you noticed, but at least 3, 4, 5 times a week on the podcast, we get a comment. Someone saying, you guys are crazy. We've been seeing every measure showing home prices down year over year. It's just not true. If you look, some of them are down slightly year over year. We're going on 4, 5, 6 months of month over month increases, and nearly everyone that forecasts is projecting an increase over the end of the year. Like Jeb, you talked about your listing in Lakewood. You have a client who made an offer in Long Beach at a similar price point. I had 3 offers go out this week. None of them got accepted. Several of them did not get countered. And that's on this West Coast California market where we were seeing a lot of weakness this year. So again, take it with a grain of salt.
To update after we get through these charts here to kind of talk about what I'm seeing right now, representing a couple of different buyers. Yeah.
Absolutely. So I didn't realize we were going to that. So all of those charts that came before is just to tell you current homeowners have little loans at low interest rates and no distress and lots of equity. So anyone expecting foreclosures, we didn't even get into the point that lenders are not foreclosing. They're just doing mods. They're just doing what it takes to get people in to stay in properties. They learned their lesson that foreclosing actually leads to a cascade, a waterfall of more damage. So they're not coming. So this is where we're going to jump in, Jeb. People always ask you, they always ask me, who is buying in this market? Well, here's the measure of who is buying in this market, the 4.2, 4.3 million sales that are going to occur this year. So again, two axes here. The left is conforming loans, Fannie Mae, Freddie Mac loans. So the average down payment is up at an all-time high here of about $36,000 or $105,000 on the conventional, a little over 105. So FHA and VA, obviously those require 0 and 3.5% down respectively. So VA has an average down payment of almost 30, FHA 3.5% down, almost 20. So that is what people are putting down to get into homes. Average loan to value of purchase rate locks. Those loan to values are going down. So think about that. You're saying, hey, these home prices are going up. No one has any money. Who is buying? A lot of this is people that are, I don't want to call them move up buyers, Jeb, because they're really people who had to move from one property to another and they're bringing in a bunch of equity, or they have significant savings, or they have a gift from family. We went from 2018, it was about an average of 10% down. We're sitting here an average of 15.5% down. That is a significant difference when you look at it in that level of numbers. Average debt to income. So people are thinking, no one can afford these houses. Well, you might think that, but is this really all that extreme when you look at this? FHA back in 2018, average DTI was for a little under 43, and now we're pushing 45. VA was a little under right at 40, and now we're pushing 43, 44. The conforming loans.
Well, one thing to context, guys, right? So there's a lot less buyers right now, right? So a lot less buyers aren't moving that number quite as much. If there were as many buyers as there were back in 2021, 2022, you'd probably have that number skew higher, at least in my opinion, Josh, just because more people would pull that debt to income ratio higher. But because less buyers, right, maybe buying at a little bit higher DTI, the numbers aren't moving as much. Is that fair?
Well, I think it's fair. And Jeb, while you said that, it kind of brought a thought to mind here. We talk a lot about, well, what's my max DTI? On that loan program, how high can I go? So what are the answers? VA doesn't really have a maximum. You can go 65, 75% in some cases. FHA, maximum 57%. Conventional, maximum 50%. Some people can't get to those levels. But if you look at this, most buyers are going, I don't want to get anywhere near that. So that average is much lower. Conventional, we're about 37%. And then non-conforming, I wouldn't even factor that in here. Non-conforming encompasses so many types of loans. If that's truly a jumbo, might make sense. Wealthier people buying more expensive homes. But those debt to income ratios trending up, obviously for obvious reasons, but not out of control by any stretch. Average credit score, what are we looking at? Again, conforming's on the left. So conforming loans in 2018, we were at about 745, and now we're up around 755. It's gone up 10 points. FHA, we went from 720 down in the middle of everything. It went down to about 710. I'm sorry, I'm on the wrong axis again. We were at 670, went down to about 660, and now we're up about 680. It's not a huge amount, but a 20 basis or a 20 point range there is significant. And kind of the thing that was interesting here to me is how much higher the credit scores are on VA. You know, they were a little bit over 700. Now we're up to almost 720, but all of those across the board are up 10 to 20 points. So people putting more money down, having better credit, and having manageable debt to income ratios. There's less of those people around there. So as Jeb pointed out, that's why we're having less sales volume, in addition to less homes for them to buy. National payment to income ratio. So what do we got on people buying right now? Payment to income is at 36.4%. So that's telling us what did we have here? If you look at this chart all the way through the first part of the pandemic, you know, the number was still really low because of low interest rates. Prices were going up, but rates remain low. But now we've seen this spike where we went from, what was it, 20%? And now we're up about 36%. That is a significant change. And that is telling you the headwind that the market is facing. And that is telling you why we're not likely to get to rapid appreciation until we get more affordability, where there's more people who can buy and are comfortable doing it. This, I thought, Jeb, was an interesting look at this chart. The blue bars are purchase lock count deficit. So loans being locked in optimal blue every week. So deficit to what? So it's from the same week in 2018, 2019. So we like to go back prior to the pandemic, say that was kind of a normal market. Well, as you look, it almost perfectly mirrors. The worse rates get, this is kind of a funny chart. The green line going lower is worse rates. The worse rates get, the bigger a deficit we have of locks to the market. So we've seen here recently another leg up in interest rates, likely to mean that we're going to have even fewer locks and sales here going forward, in addition to the seasonality of the charts that Jeb showed. So we like to show this every week. You guys always have questions about interest rates. We kind of blew through our first level of support. We have a new one here at 427. That real ceiling is 434. Ceiling there is a little bit of a euphemism, Jeb. We are hoping and praying that's a ceiling. We have not been above there in a long, long time. And if we blow that top, it would be bad for interest rates. What I will say, Jeb, I meant to tell you this the other day. Anecdotally, we have a couple of clients, very well qualified conventional borrowers. I would expect, if what I'm seeing in pricing their loan out is accurate sort of across the board, we are seeing a compression of the spreads between 10 years and mortgage rates, because we have not seen their terms get as much worse as the 10-year has gotten over the last week. The last one here just shows you where rates are at. Mortgage News Daily has the best publicly available index, other than maybe the Optimal Blue Mortgage Market Index. Quoting today, or this is from the 15th, so as of yesterday, 7.34 on an average 30-year fixed. The important one there is FHA. We always talk about how they quote a little bit high. We can usually get you a quarter to 3/8 lower than that, but they're quoting over 7%. So even government borrowers with government loans, FHA and VA, which are a little bit lower, are seeing the effects of these higher interest rates and pushing up over 7%.
All right. So are we done? Are we done with charts?
We got our preview, Jeb.
Okay. Yeah, so let's hold off on that for a sec. Let's talk for a minute, and let's go back to this one here and just say, so I'm going to be the pessimist here and say that based on looking at the chart, I think rates go higher at some point before they go considerably lower. And the reason I say that is because I think, looking at that chart, Josh, that you've got to break the old high in order for it, or at least test it, in order to see us move back down. I might be wrong. And what I'm talking about is the 10-year. So does that mean rates, go even higher? Probably. Again, we've been wrong. I've been wrong many, many times. I like reading charts. And in looking at the chart, I just feel like it's gotta break that to move back down, but we'll see. And Side note on that, if I get a lot of people reaching out, should I lock my loan? Should I do this? Should I do that? You've got to make that decision, right? Josh and I can't make that decision for you. As educated as we both are on the market and on things, it becomes how comfortable you are with the risk of not locking, for one, and gambling, so to speak, and how comfortable you are with the payment and just moving forward, as is. I tell anybody, if you're comfortable with the payment right now that they're giving you and they're quoting you rates, even if you don't like it, it makes sense to you and you're under lock the loan. Like, that is the easiest way to get the emotion out of the process, move on, so you're not constantly thinking about it. Because I think a lot of people sit there in angst every day. What are rates doing? What should I do? What should I do? Just lock the loan. But with that said, Josh, I know you probably want to talk on that a little bit, but
what I would say, Jeb, in a more standard market where we're not going on 14 months of really rates only moving in one direction, we got a couple of 2-3 week moves to counter that. But when in normal times, your rate can only do three things during your escrow period, and two of them are good. If it stays flat, that's a positive because you can end up getting a shorter term lock, which is cheaper.
Mm-hmm.
If it goes down, you get the benefit of that. And if it goes up, obviously that's bad. But you hit the nail on the head. For most people who are risk averse, the stress of potentially dealing with a higher interest rate and higher monthly payment that they may or may not be able to afford, it is not worth it unless you are a true gambler where you say, I love to live on the edge. Just lock it and get the hell out of the way until we see something that looks more like a downtrend or even just a chopping sideways market.
All right, good stuff. So, this is my channel, right? Jeb Smith, whatever. Aside from this, we have the Educated Homebuyer podcast, right? It kind of was built off of this channel to go into a deeper dive about topics to really help people become educated on the home buying process, right? My channel is a lot of the Q&A, right? The Wednesdays are Q&A. But my channel is a lot about what's happening in the market right now and maybe some tips on buying and selling property. But we never go into a deep dive of specific topics really on my channel outside of, say, FHA and that sort of thing. The Educated Homebuyer was built to go deeper. With that, there's a YouTube channel. Almost 2,000 of you guys have subbed to that channel, and we appreciate that. The podcast has now hit 100,000 downloads. Huge thanks for that. There's 2,000 of you guys, plus or minus, guys, girls, that listen to the podcast every episode that comes out. For that, we're very thankful. That said, this past week, we talked about how to budget. Budgeting is the foundation to owning a home. I don't care where you are in the process, how much money you have, don't have, how much down payment, whatever, the budget is the key. So if you haven't listened to it, go check it out. If you have, or maybe you have a budget, share it with somebody that doesn't have a budget, somebody that is buying a home, because it could really help them set themselves up for success. That said, Josh wanted to preview next week's episode. So today we recorded next week's episode. It's the idea of moving to a lower cost area to become a homeowner. Should you do it? What are the pros and cons? In fact, one of our regular viewers on here made her debut, so to speak, in the episode. We kind of used her as an example in conversation. Kim, who I know was here earlier in the show, and she posed the question, right? And so an episode was kind of built out of that idea. So if you have thoughts, questions, send them to us. We're happy to do it. If you haven't liked and subbed, do that. I want to get to questions quickly here, Josh. So let's just kind of talk about these charts and dive into it.
Basically, it's just showing the southern and westward move of migration. It's the median center of the population in the United States. So what we were obviously talking about on the show is, does it make sense if you can't afford in a higher cost of living area to relocate to buy a home? We go through the pros, cons, everything you need to consider to make an educated decision. It just so happened that this chart popped up in our feed this week. And again, kind of talking here, why is there that move? Well, this is somewhat counter to that. We have the least affordable markets are your usual suspects: California, Washington, New York, New Jersey, Miami, Florida, and then a bunch more markets in California. But despite that southern and westward move, the most affordable markets, where almost all of you could move tomorrow and buy a home if you'd like: Cleveland, Pittsburgh, Oklahoma City, Hartford, Connecticut, if you like a deep freeze, St. Louis, Cincinnati, Detroit, Indianapolis. So we go into that. There are some areas that what I would consider more desirable than some of those that are more reasonable and more affordable. But I think it was a really good talk on what you should consider if you're looking at doing that, because more and more people are. Many of you aren't. Just say, no, I'm adamant. I'm staying where I'm at. I love being here. I got family, whatever the case may be. But more and more people are considering it. And some people don't consider it enough and jump in. Jeb and I both had 2, 3, 4 examples of clients or friends who moved out of the area and rapidly wanted to come back.
Yeah. And that said, earlier I said I was going to talk about clients and offers right now. I'm going to save that to the end of the show, just so we can get to your questions, the main reason you guys are here. But if you made it this far, if you haven't done so already, hit that thumbs up. It helps the algorithm, helps us, know that you like the information, and support the channel. And for that, we're thankful. So because Kim is a regular, she was on here prior to the show even starting, putting comments in. I'm going to answer her question first. It says, in your chart, you said median homes are in the high 300s. Where are they located here in Southern California, or are they located outside of California? So that is a nationwide chart. Southern California, there is no median single family home anywhere close to that price that I'm aware of, unless it needs a lot of work. So that's a nationwide look at charts. And a lot of the homes that are in that price point are in the Midwest, and I would say the South, but the South has become crazy at this point. So the Midwest kind of leaning down into the South is where you see those homes.
Jeb,
Right.
we have a question from another regular here. Anya pipes in with home payment should be 25% of take home pay. That way you have margin for improvements and increase in taxes and insurance. Agreed. Takes us back 2 weeks ago. That's Dave Ramsey's advice. And for most people, we go through the numbers in the podcast episode 2 weeks ago. You will never buy a home. So unfortunately, unless you move to a very low cost area or have a giant down payment, most people are never going to own a home with 25% of their net pay. I don't have the chart back up, but what were we saying, Jeb? Right now, the average DTI is 36% across the country, and that's gross. So, I mean, you reduce the income by 25%, you're probably talking 45, 48, 50% of net pay. So would it be awesome if you could do it, or if you did do it? Absolutely. Is it possible for most people, or even a small percentage of people? Not really.
All right. Logical thinker. According to a new report by B of A, unemployment is rising the fastest among those earning $100,000 and higher, unlike previous downturns. How do you think this will affect real estate if the trend continues? So I'm not aware of anybody personally that's in that price, that salary area that is being affected. In fact, I haven't really heard that stat. I don't know if it's people moving from one job to the next, but unemployment rising, and that's surprising to me, just because those are the people that have the best opportunity probably to find employment, because typically if you're making those salaries, you're educated, you have experience, all of the things you need to be a qualified employee. Josh, are you aware of anything in that price point or salary?
No, but what I would say, let's say that the unemployment rate is increasing so fast that unemployment among six-figure earners is 25% higher than where it is for the rest of the population. You're at 5% unemployment, so a spectacularly low level. Those people are more likely to be homeowners. We've talked before about, if we're talking about people that make $30,000 or $40,000 a year, in most parts of the country, they're not homeowners. They have no impact on the real estate market. So your question here is specifically, how does this impact real estate? I don't think it will, because we're still talking spectacularly low unemployment levels. A level of unemployment at that rate does not generally lead to foreclosures, is not predictive of foreclosures or distress. We just went through the charts. That six-figure earner in most parts of the country is paying 20% of that income towards their housing payment, and that housing payment is $1,400 a month, lower than rent. They are going to hold on for dear life. Those people are also more likely to have a 401k they could tap, family resources,
equity in their property. And not to say that it can't have an effect. It's just not likely to, based on what I'm currently reading and looking at, not really having an impact. But time will tell. If the trend continues, then it's obviously something we need to pay attention to. There was another question here, Josh. It was pretty quick. Nicole asked, if you buy down points, is this permanent for the life of the loan? How many points can you buy down, and what is the cost usually?
So this is funny. Like, to me, I've been in this business for 27 years, and it just seems obvious. But a point, remember, a point is a percent of the loan amount. So people, what is the cost? It is a percent of the loan amount. So 1 point is 1%, 2 points is 2%. Three quarters of a point is 0.75%. So the cost of it is going to be determined by the size of your loan. So if you are paying points to buy down the rate, then yes, that is permanent for the life of the loan. But to determine the cost, you got to know how many points are we talking about? How big is your loan?
Yeah, but I think the better question is when you're paying a point, 8%, how much is that buying the rate down? Because if you pay 1 point, you're not getting a point off the rate.
So for the first couple of years of the show, we used to always talk on a normal rate sheet. It's 1/4%. 1 point will get you down about 1/4%. You could usually pay 2 points and go down 0.5%. But the further you get away from the par rate or that 0 point rate, the more expensive it gets to buy it down, or the less of a lender credit you'll get for going higher. Rate sheets have been funky recently. Lenders are wanting to incentivize you to pay to get a lower interest rate. So hopefully that loan is more valuable to them because it stays on the books longer when the inevitable downturn in interest rates comes. So from that perspective, we've been seeing a 0.5 point will get you down 1/4%. Sometimes a point will get you down 3/8, sometimes a full 0.5%. So it is very important that you work with a lender that is looking at the full rate sheet and seeing where is that sweet spot. Even at those numbers that I talked about, we normally say paying points, lenders are smart. They price that where the break even is out about 5 to 6 years. That's because they know in aggregate, when they make tens of thousands of loans, they're going to be on the books for 5 to 6 years. They don't think they're going to be on the books as long now. They would like you to pay up front and not pay out themselves. So we're seeing with the numbers I just quoted, if you can get a 0.5 point to get a 1/4% lower, that break even is about 25 to 30 months. So for a lot of people, you can pretty easily justify that. I mean, the reality is you're probably not going to refinance in the next 12 months. So your worst case, if rates plummet this time next year, you get a lower payment and you only ate maybe 1/4 of a point of that buy down. So normally I'm very against it in the current market. I'm not saying I'm in favor of it. I'm saying you need to analyze it. You need to make sure your loan officer is going through and showing you all your different rate and point options.
And that said, Josh did say it was permanent. That is if you buy a permanent buy down, right? I mean, there are temporary buy downs. You can do 3-2-1 buy downs, 2-1 buy downs, different types of buy downs where the rate isn't, down at that specific level for the 30 years. So just make sure you understand both sides of it. Talk to a knowledgeable professional. I can't talk. If you need one, there's a link scroll in the bottom that will get you in touch with Josh. It'll get you in touch with a lender anywhere in the U.S., along with a real estate agent if you need one. Daniel asked a question: are you trolling us with the name of the video? And no, I'm not trolling you at all. I mean, it says the future looks bright for the housing market. It looks bright in the sense that if you're a homeowner, prices are going to be stable. Like we said last week, the American Enterprise Institute's predicting a 5 or 6%, appreciation again next year on top of, the 3 to 4% from where we are this year. So, I mean, it looks good if you own a home. It doesn't look so good if you are struggling to buy a home, thinking you're going to wait for prices to come down, for prices to crash, for things to get way more affordable. That doesn't look so bright. Josh, we have a question about making a loft into a room. Will making my loft into a room increase the value? So what I would say is in some cases, the answer is yes. In other cases, the answer might be no. How usable is the loft space is what I would say. Have other people done it? How much square footage does it add? Would it be better as a loft? I mean, these are a lot of things you got to think about, and some of them we just can't answer. I would say having more bedrooms typically adds to the value of a home. And what I mean by that is if you have a 4-bedroom home that is 1,200 square feet, sounds crazy. They do exist here in Southern California, and a 3-bedroom home that is 1,200 square feet. In theory, the 4-bedroom home, even though it's the same square footage, probably going to get a little bit more money because it's a bedroom. Not always, but I would say that's, how I would look at it if I were just kind of comparing the two. I would say, hey, another bedroom adds a little bit more value. So that said, converting a loft could add some value. But at the same time, if you're taking a space and making it something that it shouldn't be because you just want to add a room and it makes the configuration and the floor plan funky, then it may not be worth it. So just, somebody's done it. compare your home to their home and what, yours would sell for now versus doing the loft and see if it makes sense. All right, Josh, let's see. I saw a good question. Here we go. Ile says, can annual capital gain distributions in a retirement account, IRA or Roth IRA, be used as qualifying income? Assume distributions automatically reinvest and account just sits until retirement.
It's funny, when I first read it, I just saw the capital gains. So capital gains distributions, you can only distribute from an IRA or a Roth after 59 and a half. So if you're over 59 and a half and you're not having penalties for early withdrawal and all that fun stuff, yes, we can use that in your qualifying income. And capital gains in a taxable account can also be used regardless of how old you are. You don't have to be over 59 and a half. We just have to prove that the assets still remain to kick off those capital gains. So let's say you had $100,000 in an investment account or $250,000 in an investment account, and it makes a nice return for you. In the last few years, you've had $10,000, $15,000 of capital gains. We can use that income, but we cannot use it if you're going to use that $250,000 for your down payment, because obviously it won't be kicking off that income for you going forwards.
All right, good stuff. I got a question, a little off topic here, but I'm going to put it up here because it's a great question. Says, Jeb and Josh just moved to Huntington Beach. Where are the best tacos? Josh, we've never had this question, so I'm gonna throw it your way, and then I'll answer where I think. I eat a lot of tacos, bro. I feel like a taco connoisseur. In fact,
I'm mad that we don't have Baja Fish Tacos in Huntington Beach. We've been talking to the owners for like 20 years about getting them over here. So those are my favorite tacos, and they are not here. I'm going to sound dumb when I say this, Jeb. What's the name of the place that's about a year or two old in the Newland Center? That taco place that went in there where Supermax used to be.
Oh, bro, that place has been gone forever. Oh, the new place, Que Vida?
The new place,
Oh,
Que Vida. Que Vida has good tacos. They're fancy tacos, though. You got to like
fancy taco, really good margaritas, though. The place is good. So Que Vida, good one. Sancho's Tacos, really good off PCH.
We got a vote here. Gerald piped in and said Sancho's is the answer.
There you go. Sancho's is really hard to beat. I never go down there just because it's kind of a pain to park and everything else, and for whatever reason, but Sancho's is good. Fiesta Grill. I'm a big Fiesta Grill guy.
I knew you were coming with Fiesta Grill.
That's really good. I eat there probably once a week. Those are my go-tos, man. I think those are good. I eat a lot of tacos. Chronic Taco is okay, but I prefer the other. So start with Sancho's, Que Vida. Work your way down the list there. I think do one each day of the week. You'll be really happy come Friday. That's all I got to say.
And when you're ready for breakfast burritos, go to Lupe's.
Lupe's is good too. Lupe's is good. All right. I'm really hungry now. Josh, let's see here. I saw another question come in that Maria asked a question. How does it work if you're interested in buying a foreclosed home? Can you get a mortgage loan? So foreclosures, a lot of them end up coming on the market at some point. A lot of these, what happens when a foreclosure happens, the bank ends up back with the property, and they have a team, if you will, of real estate agents that end up listing these properties for sale. Most of the time in a normal market, these properties would get listed on the MLS as a foreclosure if it goes back to the bank. Now, if it doesn't go back to the bank, sometimes and in those scenarios, it's very difficult to get a foreclosure unless you're an investor and you have cash and everything else. In the case that they make their way back to the MLS and they get listed, generally speaking, the banks are making sure these properties are sellable in the sense that there's no major issues wrong with them, that you can get financing and that sort of thing. So in the case that you need a loan, you can typically get a loan. But here's the caveat. Foreclosures, very, very small percentage of the transactions in the market at the moment, less than 1%, less than 2%, something like that. And these things are getting gobbled up. If there's any inkling of value add in these properties, or that they're selling at a distressed level compared to what the open market would bear if they were fixed up or what have you, investors are buying these things up hand over fist. So I would say don't get your hopes up. If you can find one, fantastic, but I wouldn't hold out just looking for a foreclosure. So hopefully that helps. Josh, Would you know the reason why lower down payments on a house gets people a better rate than a higher down payment? Google mortgage rate calculator is my source.
The best advice would be to not use the Google mortgage rate calculator. It's just, yeah, I don't know where they're pulling their data from, but anything online. We talk about that mortgage index, but even that, they're not breaking it down. They're not. It's not a pricing engine that they're pulling from actual lenders. We went through this 2 months ago with the LLPA changes, and everyone said, "Hey, lower down payment is better pricing." There's a small grain of truth to that, but for the most part, it is not. So it's not going to save you money. I had a client the other day that if they put 3% down versus 5% down, it saved them 0.125, 1/8 of a point. So it was true in that situation, but it was a tiny, negligible amount. It certainly didn't impact their actual decision of what they were going to do.
All right. Clips, you ask about buyer traffic and loan closings. We're going to save this to the end because I'm going to talk about kind of what I'm experiencing right now in the market. So if you're here, I am going to answer the question, but it's going to be at the end. Josh got a couple questions on rates, as we always do. On terrace, when do you think the rate would go back down to below 5%? And then Jefferson's asking, do you think rates will eventually decrease by 2025? And I'm assuming we're talking mortgage rates, right? So, the Fed funds rate will definitely be down by 2025, but let's just talk mortgage rates. When will can we see a noticeable difference?
It's funny, Jeb, if you look around, there are lots of professionals that are trying to generate business that are still talking about MBA forecast, NAR forecast, Freddie Mac forecast of rates in the low sixes by the end of the year. We've had a lot of data over the last 45 to 60 days that tells us unless we see a rapid acceleration in disinflation where we get a 2 handle on CPI by the end of the year. So not all the way to the 2.0 that the Fed wants to see, but into the 2s. I don't think we're going to see rates improve. It's August 15th. So we got what we're looking at. I'm having a hard time rationalizing and justifying where the market is right now, getting worse every day for the last week. With that being said, I would also have a hard time saying, why would they get better? Haven't seen much positive data. Jeb, you threw the chart up, I think 2 weeks ago, where we looked at the next 2 months. We have some pretty big reads from last year falling off, and they're likely to be replaced by positive reads, at least on the core. Energy is getting expensive again. We've had some things that are pushing food prices higher. So the headline may not improve as much, but the core should continue decelerating. We had a comment here, someone talking about how important the component of shelter is in those. Shelter going up. Well, I don't know what.
Same thing. Yeah.
I don't know what numbers you're looking at. Shelter is coming down rather rapidly. And if you look at either a 3 or a 6 month number on the shelter cost versus the 12-month, those numbers will tell you we're already at 2% on the core when you adjust for where shelter has been for the last 3 to 6 months. So I don't see a rapid acceleration in shelter costs. I don't think rents are going to shoot up. I don't think people's home values are going to shoot up. We've talked about several different market players that have good data that are projecting increases of 3 to 5% over the next 12 months, or some even higher. And I'm like, I look at that, I go, I don't know how, but then I also see my clients getting into bidding wars on homes that I didn't think would generate bidding wars. So all of that being said, I expect, if we go back a month, Jeb, I said, I expect a slow grind lower through the rest of the year. I have been shaken from that a little bit, but I would still say I expect a slow grind lower. And the higher we get, it means the higher we end up, because it doesn't mean that, hey, we went from 6.875 to 7.375, and I magically think that doesn't play into it. It means we're probably going to end the year 0.5% higher than what I thought, because we're grinding lower from a higher point.
Higher level.
So I don't think there's a lot of good news there. And then the first part of the question, when do we get back under 5%? I think it's going to be a while, and it really comes down to those inflation numbers and what that looks like. And there's so much uncertainty. I don't know if we can stress to you enough that we read a lot of really smart people, and I could show you 5 people that are smart
on either side
with well-reasoned arguments for either side of it. I would err towards the side of lower rates. There's some smart people out there saying it's not happening. So we'll see.
We will. Steve asked the question, in Orange County real estate market, what is the first time buyer's annual income and down payment needed to purchase a home? So Depends on what you're buying, right? I mean, if you were buying the median priced home in Orange County, is probably sitting, I mean, off the top of my head, almost 1.3. Let's just say 1.2 to be fair. And what kind of income do you need to purchase a 1.2 home, Josh? It says down payment needed. You could buy it with, probably what can you do on a jumbo loan?
1.2, we've got the source for 10% down. A really good
Okay, so you
source
can
for
buy
a
it with 10% down. 1.2, you probably got to make $250,000 a year, single, combined, somewhere in that ballpark.
Well into the twos for
Yeah.
that. Just that payment's higher than what you think, and you're going to need to be well into the twos. I would say north of 250. So if you're saying something affordable, what's an entry level home in Orange County? Probably the cheapest you're going to find is 750. 850 is probably more reasonable. So again, 10% down. We got an $800,000 loan. We're still talking $6,500 house payment on that at that level, maybe even a little bit higher. I haven't run that exact scenario recently, but say it's $6,500. Max debt to income on a conventional loan is going to be 50%. If we're not doing a jumbo loan there, so let's call it 50% for a well qualified borrower. We need $14,000 a month income. So that number, depending on what home, what size down payment, you're looking at probably 160 to 300 needed to get in and make it happen.
All right, good stuff. The flight simulation experience says $400,000 budget, looking to buy a rental property, 1-bedroom condo in Southern California. Is Huntington Beach an option, or where would you recommend? So Huntington Beach is not an option, unfortunately, at that price point. I wish it were. I would tell you to take your $400,000 budget up to like the Central Valley, and buy a single family home where you can get a decent amount of rent. And that's where people are moving and likely going to continue to move as they get pushed further and further out of LA and higher cost areas. And then it probably ends up being a really good investment long term. I think you're up in like Manhattan, Redondo. So you're, a little bit closer, not much closer than we are, but 30, 40 minutes, which means you're like a 2.5 hour drive to that area. I would consider it. I wouldn't say it was out of the cards. If you're looking for single family, if you're looking for a condo near the coast for that price point, you're gonna have a really hard time. You're gonna have to be in Long Beach somewhere, and probably not what you want to own, in my opinion. But just my 2 cents. Josh, we have another one here that was really softball. Just throw it to you.
Those are the only ones I get, right?
Fragment Coder says, is it possible to get a mortgage on only 20% of the home value and pay the rest in cash?
Absolutely. I have a client right now. One of my financial advisors is buying a home here, and he's putting a little more than 80% down, getting a little $300,000 mortgage on a couple $1 million property. You can put as much down as you want, as long as the lender is still able to make the loan to you within guidelines. We've talked before on the show. You're trying to get a $50,000 or $60,000 mortgage. It can be very difficult for a lender to stay within the guidelines of what is allowed to be charged to you and still make any money on that loan. So some lenders have requirements of a minimum loan size, but once you meet the minimum loan size requirement, you put as much money down as you want.
All right, Nadine, why do some lenders require an appraisal where others don't, even if you do not waive your appraisal contingency?
All lenders are going to require an appraisal unless they get a waiver through one of the agencies. So FHA doesn't do waivers, VA does not do waivers, USDA does not do waivers. So Fannie and Freddie have systems where if you are a very well qualified borrower putting a substantial down payment and they have enough data on your home, they may conclude that the risk does not warrant them needing an appraisal. We have the American Enterprise Institute tracks that, and the numbers are way, way down. As soon as the market leveled off, when the market was going up 15, 20% a year, they were handing those things out like candy to well-qualified borrowers because they figured that the equity was good and going to be better in another 12 months. Now that the market's relatively flat, I had one on a 20% down here recently, and I was almost shocked to even see it. You talk about different programs like second mortgages, HELOCs, that type of stuff. Lenders can sometimes use an AVM or something in lieu of an actual field appraisal, but for the most part, it really comes down to whether Fannie Freddie automated underwriting system gives a waiver.
All right. Let's see. I'm going to just answer the first part of this, Josh, and you can get the rest of it. Nicole says front end and back end DTI, which is better? They're indifferent. The front end ratio is basically your housing expenses alone, right? So mortgage, which includes principal and interest, your property taxes, any insurance, HOA, all of that is included in the front end ratio. The back end ratio is all of those housing expenses plus any other debts you have, student loans, car payments, credit cards, all of that added in. It's your back end ratio. So which is better? I mean, there's no correct answer to that. But Josh, is it better to have little debt or for DTI or no debts at all? So if you have no debts at all, you qualify for more in theory, right?
Yeah, if you have no debts, you will qualify for more. It used to be back in the day, you would hear things like the ratios need to be 28 over 36. So 28 housing, 36 when we add in the other debt. See, you got in late, Jeb. When I started, it was even lower than that. They would loosen them up some by the time you had got in. But the only one that really still has two separate ratios is FHA. You go to 47 on the housing and 57 on the total debt to income ratio. VA does a single ratio for all intents and purposes. Conventional does a single ratio. I've seen situations where it won't allow a high single ratio. But when you say which is better for you? If you have no other debt, you're going to qualify for more house with every program except FHA, because they're going to cap you at that 47 regardless of what the other debt is. But it's only better if you want to be qualified for more. Most people that I look at, I say, here's what I can get you qualified for. And they go, ooh, no thanks. I need a lower payment. And so we back it off from there. So really that's what it comes down to. If you're trying to max out your qualifications, no debt and a single ratio. If you are just trying to live life and you like to have a new car every 4 or 5 years that necessitates a payment, you're going to have some debt.
Good. I'm going to answer Kirson's question in a bit about new construction here in just a minute. Josh, let's see. We'll go Elay. Which is better, buy in low cost area and anger neighbors for making their area unaffordable, or don't buy in a high cost area and be mad at neighbors for making my area unaffordable?
So
I think just have a positive attitude and don't worry about what your neighbors are doing. How's that?
Exactly. I think this is mind-boggling to me that people get mad when someone moves into their area. A buyer buying in an area did not dictate the price of an area. Supply and demand did. So you get gentrification. We've talked about this on the show. I always go back to you see the scene in Boys in the Hood where Trey's dad explains to him gentrification and how the people were coming in and taking over the area. Now in Southern California, many other areas, the people who are gentrifying areas are no longer white people. They're professional, educated, urban professionals.
I mean,
so
that is a really good example, because you're using a movie, right, that was based in South LA in Compton, and it got regentrified to some extent, right? From where it was then, or definitely from where it was then to now. And look at what home values and businesses are there now. And, you don't have anything like you did back in the late 80s, early 90s. It's a completely different market because of that regentrification. So, did you want to add to that, Josh?
No, I was just going to say, going back to something I told you about earlier, in researching today's podcast episode, I read an article, and it was one of these urban institutes on planning and resources. And it was the most insane thing I've ever heard. They were saying as though it was a government plot to make homes expensive in areas where jobs are really solid. So funny thing, when you have awesome natural resources like lakes, beaches, cool things, and then you have plentiful, high-paying jobs, there's limited amount of land. Those home prices are going to go up in value. So Compton was never, due to crime and other issues, became an undesirable area to live. But as prices in other areas got pushed up even higher, then people said, hey, this is still 10 miles to LA. It's still 8 miles to the beach. I'm cool living there. And they went in and prices went higher. So it is always a function of supply and demand. We've talked about here on the show terrible decisions that the government has made, like buying mortgage rates down under 3% and keeping them there a year longer than needed. There's things you can be angry at. Don't be angry at supply and demand. There is a finite supply of land and homes in areas that are desirable and in demand. I can't get angry that I can no longer afford to buy a home in Newport Coast or Corona Del Mar or Beverly Hills. That's just the way it is. There's a finite supply of land there and a limited supply of homes with ocean views. And if you want one, you better be prepared to pay an awful lot of money.
All right, good stuff. So 2 questions on DTI we're going to go through really quickly. Nadine says, if you have no debt, then the front end and the back end are the same ratio. And the answer is yes, that is correct. Yeah, if you have no debt, the both are the same. Kim says, what is the formula you use to get your DTI overall? I was told I'm 11%, but I want to do it myself. If I remember, there's a video, blah, blah, blah. So what you do is you take your salary, your income. If you're a W-2 employee, take your annual income, divide it by 12. You'll have your monthly income. You take your housing expenses, whatever that's going to be. Let's say your $2,000 mortgage, $1,000 property taxes, $500 HOA, you're at $3,500. Let's just use those numbers. You divide that into your salary, that's going to give you your front end ratio, right? If you have any other debts, car payments, student loans, credit cards, anything that reports on your credit report, you got to take those monthly payments and add them to those housing expenses and divide that into your monthly income, and that'll give you your back end ratio. Fair, Josh? Easy?
Yeah. And what I would say is everyone says, I want to do it at home. Never, other than the guy or girl who says, I make $42 an hour and I work 40 hours a week, or I have $112,000 salary. Only those people are capable of figuring out their qualifying income. If you have any variable feature, if your hours vary, if you get different shift differentials, bonuses,
Overtime.
commission, overtime, you are never going to get it correct.
Correct. There you go. So talk to a professional. If you need one, there's a link scrolling the bottom. All right, Josh, got a couple questions here. We're at 5:55. I want to get into them real quick, and then we'll say sayonara. So Kirsten says, is it better to just buy new construction to avoid bidding wars? And I want to address this question because, for one, we got builder sentiment out yesterday, I believe it was. They basically said builder sentiment was down, and down considerably month over month. At the same time, today we got housing starts. Housing starts are actually higher than expectations, but they're a little bit lagging because they're from the previous month. So what I will say is that if builders, housing starts are the start to build a house. They haven't broken ground, right? It's permits pulled. I mean, it's very early in the stages. But if you're in an area that gets a lot of new construction, they're just finishing houses, and rates stay higher, it may be a really good opportunity to, I would say, get a deal, but not have to deal with competition. And maybe there's some work there. Not work. There's a negotiation able to take place in those scenarios, because builders, again, aren't in the business of holding on to homes. This is what we saw late last year. New construction come to the market, rates were higher. In that case, builders were able to buy down the rate where it made it a little bit more reasonable for buyers to push forward. They still may be able to do that, but there's a reason that builder sentiment is going lower, and it's because rates are a problem, guys. And I think, new construction is the answer in many, many ways, but it's one of those things that's going to be the next 6 months or so with rates and supply are going to tell a lot about the housing market. Josh, anything you want to add on that?
No, but there was a follow-up here that I do. So Kirsten says, I recently went under contract for new construction since they were offering an incentive of $25,000 because the preferred lender is offering. The preferred lender is giving you nothing. The builder, through their subsidiary, who is the lender, is subsidizing the cost of your loan. They have enough in the margin of the home that they could do it. There's no lender who's just saying, hey, you know what? We didn't want this $25,000. They're not making $25,000 on your loan. This is the reason, more so than being able to just write up a contract and not get into back and forth buying and selling. This is the reason why new construction has been so desirable over the last 12 months, is that builders have been able to subsidize the cost of the mortgage, and you're able to just go in and write up an order with a salesperson versus the bidding wars. So we're seeing a little bit less of that. This time last year when demand was really low, builders had to do that. They're starting to see that they can do less or sometimes no incentives. So it just depends on where you're at and what they're needing to do to move homes. If it works in your favor, definitely not a bad thing, but just be aware it's coming out of the builder's margin. There's no lender that just has 25 grand profit in a deal to give to you.
All right. So Clip Sports asked a question earlier, in terms of buyer traffic and loan closing, are you guys seeing lower than pre-pandemic levels or just flat? So the number of closings definitely lower than pre-pandemic levels. There's just less property on the market prior to the pandemic. So everything is less to some extent. That said, what am I seeing right now in the market? So Josh, I wrote 3 different offers over the weekend, 3 different buyers. One of them, I wrote 2 offers for one buyer and then wrote 2 other offers. So wrote a total of 4 offers. Every single offer we wrote had appraisal waived and loan waived on the contingencies, shortened the time frame from 30 days down to 21 days. All of them had deposits of 3%. Actually, one of them didn't because part of their funds are coming from the sale of their home. So they were less at 1%. But one property was priced at $899, 875-ish. We offered 925. They didn't get it. They had several offers over 950. One was listed at 899. We offered 925 again. That's kind of their cap. Property sold to a cash buyer over $1 million. Those were both in Long Beach. One in Ladera Ranch that was listed at 1.3. We offered $1,350,000, so $50,000 above the asking price, and we gave them 40 days free rent back on that one. In addition to everything else that we offered, we didn't ask for termite, we didn't ask for a home warranty. We made it as clean as possible, and again, pushing the upper limits of their budget. And they received an offer considerably, we don't know what price it was, considerably higher than us and more favorable terms on the rent back, which we gave them 40 days. So it was obviously more than that. And then the other one, I'm trying to think what deal that was. I don't know. I'm drawing a blank, but everything I see that's in this 1.3, 1.4 and under price point is going above the asking price, multiple offers, so on and so forth when it's priced right.
And it's crazy.
It really is crazy. It is
never in my life did I think we would be talking about, the affordable things under 1.2, 1.3 with 7% interest rates. Maybe when rates were 3%, you could look at a 1.2 and you're like, wow, that's amazing how low that payment is for a fairly big loan. It's crazy. There's no two ways about it. What I would say, Jeb, many of the people that reach out to us are saying things like, this is crazy, this has to change. Because something is crazy does not mean that it has to change. It really, truly does come down. We
said it last year. The market can stay irrational longer than most people can stay solvent, right? So that has to do with the stock market. But in this case, the market can remain irrational longer than most people can stay sane about it. I mean, it's really, I'm still like last year, this time, I was telling you the same thing. Mine's boggled every time I put in an offer and it goes well above the asking price and there's multiple offers in these price points. But yet I'm still boggled when it's happening now. Even though I'm an agent and I put in offers, I received 26 offers on a property I listed personally. I know that's the market we're in. And yet I'm still baffled that there's multiple people still battling in this environment with rates this high. Crazy talk. With that said, Kirsten, thank you for the $2 super chat. It is appreciated. Guys, it's been an hour and 2 minutes. If you have found any value in tonight's episode at all, there's only 60 likes. If you could hit that like, there's 172 of you watching. Again, it helps the channel, helps the algorithm, helps us. If you haven't listened to the Educated Homebuyer podcast, go to the YouTube channel and check it out. This past week, we talked about budgeting. Previous week, we talked about Dave Ramsey. Next week, we're talking about low-cost areas, buying in those areas. And if you need Josh, you can get him on that link below. If you need me, that same link works. Would love the opportunity to guide you through the real estate process myself. And Josh would love to help you with the loan. With that said, Josh, any parting words this evening?
Just continue to educate yourself, do your research, do what's right for you. If homeownership doesn't work out right now, you're trying to enter the market and it's just not working out, keep doing the right things. Saving for retirement, saving aggressively, budgeting, living within your means, considering moving out of the area. None of these are necessarily the right decision, but there's fundamentals that you want to do regardless, and be prepared if and when an opportunity presents itself. I just see too much. We got a 1-star review on the podcast today. The podcast has 4.9 and change reviews across 100.
This is classic, by the way, guys.
Yeah, you need to read the review. They were mad at us because it's two white boomers. A couple things. They were right. They at least have eyes. We are white. But neither of us are even within a mile of being boomers. And they were mad that we didn't understand how impossible it was for a young person to accomplish anything in life.
We are the problem, Josh.
We're the problem. I mean, at the end, I almost agreed with him. I said, you should shoot yourself because it seems like there's no possible good outcome for you in life other than leaving people 1-star reviews. But
we are not supporting any bodily harm here on the channel, just so you know.
We are supporting you being positive and saying, hey, there are things that suck that are reality. We don't have to like them. If you're 350 pounds, you can be mad at gravity, or you can say, here's what I can control. So that's all I'm saying. Focus on what you can control, get clear on what you want. What are the things that you can do to get where you want to go? As soon as you say, Jeb and Josh, the white boomers on the internet are the cause of me not owning a home, you have given up all agency, all power, all control to change your life in whatever way possible. So don't do that. Don't give Jeb and I that power.
I said it a couple of weeks ago from Jim Rohn himself. Change your philosophy, change your life, right? If you think you can't, you probably can't. If you think you can, you definitely can. Just create a plan, follow it, and again, anything is possible, guys. It sounds so cliche, but it really, really is. So for, you guys being here, trying to educate yourself on the home buying process, congrats to you guys. With that said, if you do listen to the podcast and you haven't reviewed it, go do that. We need to push that 1 star down now, and we need more reviews to get us back up to a 5.0. But anyway, really thankful for everybody here. You guys continue to push the show. Next week, I'm gone. I meant to ask earlier in the show, so Josh is either going to be here by himself or he's going to have a guest with him. Do you guys want to see a guest with Josh, or would you like to see Josh just by himself for an hour? Let me know in the comments right now. We're still here. We got 171 people. Let's see.
Hey, we could bring in Finoglio and he could talk to the people about $2 million loans for $5 million properties.
Finoglio has practice today, football practice. So I don't know if Finoglio is going to be able to help. But if you do want Josh to have somebody with him, who should he have? Who should we ask to fill in with Josh? There's no comments, Josh. So clearly, Josh, Josh both.
Should be his own guest is what they're saying.
Josh should be his own guest, I guess.
Josh and tacos. Gerald says Josh and tacos. I like that.
If you bring tacos to the show and eat them here on the air and do like a live taste testing of like different places, you might win the crowd.
I don't think it'll be a good show because I'll be the only one. Cool.
Jennifer Beeston. Josh with a guest would be cool, but he is entertaining by himself. Oh, that could be you guys are feeding the ego here, guys. I'm not sure.
I paid Nadine. I give her
Jennifer. I could get Jen on here with you, Josh, and you guys could, Jen's pretty funny, man. She could, you guys could rally, but we'll see what happens here. All right, we got a couple people. Either way, Josh will be here next week to hold down the 40 Dave Ramsey on. If you have a connection, we would love to have him.
We got a connection. We'll get him in.
All right. That said, guys, we appreciate you being here. Buy right, borrow smart, build wealth. Next time, adios.
Amigos.